Silver will outperform gold over the next year or so. And if you go back and look at the prior bull markets of the last 50 years in gold, silver tags along, but quite often during a lot of that bull market, silver flip-flops around, sort of like a wet noodle. Yeah, it's going up gradually with gold, but it's not sort of with the same tonal firmness. And so it's discouraging to look at silver. But it's late in those bull trends that silver goes ballistic. If gold went to 8,000 and silver went up to 2.5% of the price of gold again, whoa, a couple $100 silver. Now, is that outlandish? No, it's not. Think about it.
MichaelOliver of Momentum. Structural analysis emphasizes that silver outperforms gold, especially in the later stages of bull markets. Drawing parallels to historical data, Oliver suggests that if gold follows a typical upward trend and reaches $8,000, silver could experience a substantial surge, potentially reaching several $100s per ounce. As of now, after setting a record daily closing price, spot gold continues to trade at elevated levels, with analysts anticipating its strength to extend into the new year. Notably, spot silver is displaying a bullish inclination as markets conclude 2023. During this post-holiday trading week, silver is confined within a familiar near-term range, fluctuating between $24.00 and $24.60. CPM Group supports the idea that silver outperforms gold during rising gold prices or bull markets. This trend has been observed since the delinking of gold prices from the dollar peg in 1968, with silver consistently outperforming gold during ascending gold price periods. Oliver delves into historical performance, focusing on the 1980 and 2000 to 2011 bull markets. Notably, in 1974, silver lagged behind gold for 2 years before staging a remarkable catch-up rally, surging 125%. This rally marked the end of the first leg of the great bull market of the 1970s. During the 1980 bull market, the gold spot price multiplied more than 24 times, reaching over $850 per ounce by late January 1980. Similarly, in the 2001 to 2011 bull market, interim price highs were witnessed, with gold exceeding $1,900 per ounce and silver nearly touching $50 per ounce in 2011. Interestingly, the current 21st century bull market is unfolding at a duration approximately 2.5 times that of the 1980 version. Let's delve into key moments from MichaelOliver interview with these video clips.
You look, for example, at the bull market that peaked in 1980 for gold. Gold had gone from a low of 103 in the summer of 76. And by 1980, January 1980, it was 850. Okay, huge move. But a lot of the gold move occurred in that last year, 1979. But if you look at silver in that last year of what had been, multi-year bull market, actually you can go back to the early 70s where that bull market really began in the $30 zone. Silver went ballistic. It beat the pants off of gold. And the same is true in the 2000 to 2011 bull market in gold, where in 2010, silver started to outperform gold vastly. And we expect the same thing now. So what we're monitoring for is not just the net trend and the momentum dynamics of silver, which are, by the way, positive. Yes, there seem to be lagging gold, but they're really not. There's more waffling sideways for the last year in terms of where silver in relation to gold. It won't take a lot in terms of that spread relationship. For example, I think the spread right now is about 1.8 something percent. You get up to about 1.2 something percent on silver versus gold, meaning now you get up to about 1.2% where the ounce of silver is worth that much of gold. You're going to break the spreads out, meaning the spread relationship between silver and gold will go from a corrective mode or sideways mode recently into an uptrend again. And I think that'll be pretty much timed with silver starting to go ballistic again. And frankly, I've said it before and I still stick with it. In the latter phase of this bull market, and we might be approaching that in 2024, 2025. After all, it's been an 8-year-old bull market already. Gold bottomed 8 years ago to the month, okay? You get that old, the bull markets are 9, 10 years sometimes. But it's in that last year or so where the ballistic nature of the market occurs. And that's when silver goes ballistic. And a point I've made before is that's when silver could go up to, for example, if you look at a silver spread versus gold going back 50 years, you'll see that it's gone up to 2.5 to 3.5% of the price of gold quite a few times, not just during those bull trends, where the 1 ounce of silver is worth 2.5% of the price of gold. Well, if gold does a normal geometric logarithmic scale uptrend, as it's done a couple times in the last 50 years, where you measure bear low to bull high, eightfold moves. They're almost common. Well, we started from 1,050. Eightfold means $8,000 gold. And you think that's outlandish. Well, it's done that ratio move a couple times before in the last 50 years and had far less motivation to do it than our fundamentals right now, which are far more dangerous and therefore positive for gold. Well, if gold went to 8,000 and silver went up to 2.5% of the price of gold again, whoa, a couple $100 silver. Now, is that outlandish? No, it's not. Think about it. And a lot of that usually occurs very late in the bull trend. And I think we're starting to get into that phase right now.
In Michael's assessment, the outlook for gold remains optimistic, offering a compelling investment opportunity. Gold is a primary alternative across various asset categories, including T-bonds. The positive outlook on rising gold prices and lower yields in the T-bond market aligns with the broader sentiment favoring gold as an attractive investment. During its final monetary policy meeting of 2023, the Federal Reserve hinted at the potential for 3 rate cuts in the coming year in its updated economic projections. Concurrently, the CME FedWatch tool indicates that markets are pricing in nearly 200 basis points of easing in 2024. Notably, there is an expectation in the market that the central bank might commence easing as early as March. Michael emphasizes that gold is the primary beneficiary amid these developments, particularly in anticipation of the Federal Reserve's softened stance. Historical patterns suggest a correlation between a more accommodative monetary policy and increased gold prices. As of late, gold prices are on track to record their most successful year in 3 years. The catalysts behind this surge include growing expectations of U.S. interest rate cuts in the early months of the upcoming year. Additionally, geopolitical tensions, such as the conflict in Ukraine and disturbances in the Middle East, have contributed to an increased demand for safe haven assets, further bolstering gold prices. Let's get back to the interview.
When gold went up early this month, in fact, it was December the 3rd, Sunday night electronic trading, gold tagged the front active month, February, tagged 2,100 for the first time in history. All the prior highs of 2020, 2022, and early this year were all up in the 2050 level, but never could get to 2,100 on a $50 increment basis. When you hit 2,100, there were so many buy stops that were just laid there, ready to be triggered. Of probably 1, shorts who wanted to get out, and 2, new longs who said, okay, I now believe I'm going to get in. And within 40 some odd minutes, you went from 2,100 to 2,150 with about just short of 50,000 contracts traded. That's unbelievable. What it says is there was a massive amount of buy stops there, that once you hit 2,100, they were executing the orders, okay? And you gushed $50 higher. But as soon as you did, if you'll think about the mechanisms involved here, all the buy orders from 2,100 through 2,150 were filled. If the market started back down, and as I understand it, the Bank of International Settlements sold some gold there was nothing below. I mean, and all your buy orders had just been exhausted. So it was like a void. So when they sold, whoosh, you went back down and you dropped for 1 week, got down under 2,000 again. I think it was 2080 something. And all of a sudden you're back up pressing 2,100 again, this time resolutely, not explosively, meaning demand is driving gold right back up again. So that collapse we saw from that 2,150 high was largely an aberrational thing due to the nature of the orders that were filled, the void in the market, and therefore it largely explains the vacuum effect when it started back down again. But then again, demand came in and we're back up pressing that level where, you close the month here tomorrow. It's a new high monthly close above prior highs, et cetera, et cetera. And it did it resolutely. So we still see gold as quite an opportunity. We see it as the prime alternative to the other asset categories, including T-bonds, which we're positive on T-bonds right now in terms of rising price, lower yields, but not in the long term. Gold is, I think, the chief beneficiary because, again, the Fed has to soften, and that's what drives gold, is central bank monetary flooding. Lately, we've seen technical evidence in our view, that those big blue chip miners, which have underperformed gold since about a year ago, In other words, while gold went into mostly a range-bound situation, they actually declined. They're now turning up credibly. In fact, more so than gold is on a percentage basis compared to like the low that was made a month or two ago, for example. And I think it's evidence that you're getting large asset managers who are not gold bugs now, but who see the monetary consequences of what's out there. They see that the Fed's going to have to soften to protect their bond market, for one thing. They also don't trust the economic metrics, the data points. Besides, those data points always lag the stock market anyway. In other words, it's never at the top that you all of a sudden see all these truckloads of very negative data points. They come in later. So these large professional asset managers, I think, are making that decision to shift. And of course, with gold miners being a very small sector, what does that mean? They're grabbing a wet bar of soap. And that's why we're seeing the blue chip gold miners start to outperform again. So I think it's happening, that transition. And once we get some evidence of rollover again in the stock market, it won't take a lot. You're going to get more of that asset class flow out of stocks into gold mining stocks. And that'll be further evidence that, there's a mental shift underway.
With markets pricing in nearly 200 basis points of easing, how does this expectation align with historical patterns of gold performance during periods of central bank policy softening? As investors consider alternatives within various asset categories, what factors make gold particularly compelling in the current economic landscape? Share your thoughts in the comments section. If you liked the video, please subscribe to our channel and remember to activate notifications by hitting the bell icon. Your participation means a lot to us. Thank you.